Alright, so today I wanted to make a video on a stock that is very popular, Costco. This is a stock that I've wanted to own for a good amount of time now, and there's one reason and one reason only that I do not own it, is because it is too expensive, which I will get into. So let's break it down here. Again, this is a $300 billion company, massive company. Again, dividend yield, current dividend yield is about 0.6%. The free cash flow yield is about 2.9. Again, this company's up massively on the year. I mean, or at least going back a year. Again, it's up about 38%, right? And in the lowest point it's been at was about 465. That was almost exactly a year ago. I mean, even going back a month, again, this company's just super high. A lot of people are probably going to ask, okay, well, where would you be buying? I'll get into that, right? So let's get into it a little bit deeper here. Again, analysts, moderately bullish. Dividends, I'll get into later. Financial health, again, solid. It's not great, but it's solid. The growth is solid as well. Profitability, again, not great, but again, this is a glorified grocery store chain. Again, these are businesses that never have super high profit margins, right? They get by on selling a crap ton of stuff, right? So that's what I would point out there. Management, again, okay. Stock-based compensation is definitely a little bit of a concern, but you look at return on invested capital, 37%. That's crazy good, right? Crazy good. The valuation, this is the main thing here. Price to free cash flow, I don't think is the best way to value it. And I'll get into it when I get into it a little bit deeper here. The PE, 46.52. 5-year average is 37.8. Again, well above that. It's just too expensive, right? Let's get into the metrics here. Let's dig a little bit deeper in the financials. Again, balance sheet, again, like I said, solid balance sheet. 61% assets to 39% liabilities. That's okay. That's decent. Again, if we look at the profit margins here, again, they're never solid. Like, again, this is a grocery store company. If you look at operating cash flow margin, going back to 2017, even 2016, they're between 2.77 and 5.31. That's just what you're looking at when it comes to grocery stores. If we look at the cash flow here, again, they've been buying back shares consistently going back a long time. They did take on debt in 2019, 2020, and 2021, which is obviously a little bit concerning, but they have paid down that debt basically in the last couple of years. So that's good to see. Again, they don't have a concerning amount of debt, but probably a little bit more than you'd like to see. The dividend, again, very important here. 0.6%, they're going at 12%. Just over 12% per year. Payout ratio is about 27%, right? So again, not a concerning payout ratio. They're going to keep increasing that dividend. Again, this company massively has outperformed the S&P. Again, they're up 572% in the last 10 years. The S&P 187, right? So just massively outperformed. Which again, for basically a grocery store chain, that's pretty impressive. Very impressive, actually. Analysts, again, the average analyst actually expects it to come down a little bit, but again, that's expected given it's clearly expensive. Speaking of expensive, let's get into it a little bit deeper here. So the first thing you'll notice here is judging it based on price to operating cash flow is a lot more accurate than price to free cash flow or free cash flow. Again, free cash flow is the number in orange here, which is all over the place. Operating cash flow is the number in green here, which is actually clearly a better marker, right? So if we look at that, going back 10 years, the average price to operating cash flow is 18.8. The current price to operating cash flow is 23.1, right? So that would mean you'd have to come down roughly 15 to 20% for it to be actually worth it. But another thing that you'll notice here is if you go back, let's go back maybe 5 years, just out of curiosity here, it's actually 22, and right now it's obviously 23.1. So depending on when you're looking at, it's either clearly very expensive or just a little bit expensive, right? So if we look at the operating cash flow per share growth, they've grown it at 17% per year over that period of time. And the actual share price growth rate has gone up 5.2. So again, that number, you want the number to be clearly higher when it comes to operating cash flow per share growth as compared to the growth rate of the actual price that people are paying. If we go back, let's go back about 10 years for a better sample size here. They've actually been growing faster over the last 5 years than the last 10 years. So it is fair to say that if they're growing faster, then you should be paying a little bit more for the shares. So based on what I'm seeing, I would say fair value is probably around an operating cash flow of maybe 21. So we're looking at probably a 10% drawdown from where it's currently at would be a fair price. And if we go to where it's currently at, we're at 683. 10% of that is roughly, I don't know, $75 roughly. So low 600s. Low 600s would be roughly fair value for where it's at right now. Preferably you're getting it below fair value. So I would say that based on current levels of earnings, if it goes below 600, it would be a buy in my opinion. Right? My opinion, do your own due diligence. But again, that's what I'm thinking here. How long has it been since it's been that low? Actually, as recently as November. Right? As recently as November. But again, you also have to keep in mind that when you're giving price buy targets, you have to keep in mind that earnings or operating cash flow or free cash flow or whatever metric you're going on, that could change. So if it goes up, okay, well, that's going to change the price target a little bit. If it goes down, that's going to change it as well. So you got to keep in mind that that will change, especially considering companies are coming out with earnings this week and the next week and the next week after that. I think we're going to have some busy earnings weeks. So things certainly could change. But I wanted to talk about this company because I think it's a very good company. I think it's something that I would have no reason that you wouldn't want to own it. I don't see why anyone wouldn't want to own this company if it got to a fair value. And for the reason being, they still have a lot of growth potential. I mean, yeah, they're pretty saturated when it comes to the North American markets, but what about South America? What about Europe? What about Asia? Obviously, it's harder to grow in those markets you're not familiar with. But again, I still think that they have a lot of growth opportunities. And considering they clearly have a lot more room to run than like a Walmart does. Again, I know they're not direct competitors, but they're in similar areas. I think that they certainly do have room to run, and honestly, they might even be more diversified than a Walmart. That's something you'd have to dig deeper on, but that is my opinion when it comes to Costco. Right? Like I said, $600 roughly based on current levels of earnings. That's what I'm looking for. And again, it hasn't been there in a couple months, but we will see. Right? We will see. I would want to see a pullback there. That probably would be below the 50-day moving average as well. So that's something to keep in mind too, that a lot of times if a company starts falling, you don't want to catch a falling knife. I think that this company will be fine over the long run, so I don't think you'll run into a lot of issues, but that's another thing that you always want to keep in mind. So anyway, that's what I think about Costco. If you liked the video, please like, comment, subscribe, all that good stuff, and stay tuned for more.